If you're trying to build a portfolio and you're chasing rate as your number one priority, just go directly to the bank.
I think the perception with rooming houses has come from share houses. So people do think that you're getting a lot of people in there that are, mooching off Centrelink.
Underinsurance is the biggest issue that we see. Building costs, labour costs, replacement rates gone through the roof.
You'll spin your wheels, you'll try and get the cheap money rather than getting the money that's actually going to get you, or getting the funding stack that's actually going to get you the deal. If you actually already have a property inside of a self-managed super fund and you have a loan on that property.
When you are doing the same deal type and you're dealing with the same client type over and over again, your ability to get the options and the strategies to the client in a refined, fast manner.
No longer is a property manager just a rent collector for you.
For heaven's sake, if it's with one of the major banks, please get in touch with me. I actually helped a client that was on 10.74% get their loans down to about the 7.1% mark. That's almost a 4% saving. Hey everybody, welcome to this episode of Finance This Property That. Another hot topic that a lot of my clients have been asking around is offset accounts. I think that this is probably one of the most misused tools in finance because people don't use them properly. So what I want to talk about is, well, firstly, let's educate. What does an offset account actually do? Talk about why people don't use them properly. And how do I build offset accounts in strategies for clients? What does that look like and why do we do that? Awesome, let's get into it. So, hot topic, offset accounts. What do they actually do? Well, it's pretty simple. If you have, in a nutshell, it reduces your daily interest. It does not reduce your repayments. It offsets the interest, like it says. And it gives you flexible access to cash, all while still reducing your daily interest. Now, some of you might go, hey, hang on a sec. Isn't that the same as a redraw? Technically, yes. And also, well, technically, yes, but they're just used in different ways. And it really depends on how you're using them and what you're using the money for. So a redraw does the exact same thing, but the redraw sits inside the home loan. So what it looks like it's done is, let's say you've got a $500,000 home loan. You get $100,000 cash and you put it into the redraw, you'll see that your home loan reduces by $100,000. So your home loan is now $400,000. You're paying interest on $400,000. Again, it does not change your repayments. You're still making the repayments as at $500,000. Switch that over to an offset account. Oh, sorry. And then if you want to take the money out, you then need to do an internet transfer into an account, and that's how you take it out. You must also have 1 month's worth of interest still in that redraw facility. You can't pull it all out with some lenders. Again, check with your bank. Whereas an offset, you've got a $500,000 loan and $100,000 in cash. That cash is sitting in your offset account. Your loan's still $500,000. Your cash is $100,000. 500 minus 100 equals 400. So you're still paying interest on 400. Repayments are still the same. However, the biggest thing is accessing that cash. And I'm going to talk to you about a strategy later that we use for a client to maximize their tax deductions for when they went and did their purchasing of investment properties. So why do some people, they don't use them properly? Well, firstly, they don't even know what offset is linked to what loan. People have offsets offsetting the wrong loan. What do I mean by that? Awesome. Good question. If you have an investment property, that is a deductible loan. The interest on that is deductible. I see a lot of clients with offsetting that loan, and then they're going, I pay too much tax, I'm not getting the maximum tax deduction. One, their accountant's not even picked it up or done anything, they've just tick and flicked. Two, their old broker didn't even pick it up or say anything. And more importantly, You as a client are responsible for your lending. I'm sorry, you can't rely on a broker or a bank to do things and get it right 100% of the time. As much as we like to, a broker can't sit there and they can't access your accounts, and we can't make changes to your accounts. We can't go and make the changes. That is against bank policy. However, we can advise and say, hey, look, you need to actually go speak to the bank, do this, this, and this, but we can't sometimes do it for you. We try as much as we can to get I know my team do, we try and get the structure right, but we can only get it to a certain point, and have the right offset sitting against the right loans. So that's one place. But then also these clients have an owner-occupied property with nothing offsetting it. But they thought that was the offset for the owner-occupied. They just didn't ask the question. So that's when it doesn't get used properly. Also, you're mistaking offset accounts as savings accounts. So what I mean by that is you've opened up an account. It's actually a savings account, but you thought it was an offset account and you thought it was offsetting your interest, but except you were earning 3-4% interest, and therefore that has to be declared on your tax. But you didn't realize that because you don't pay enough attention to your internet banking and what's going in and out. Again, I'm going to say it, your banking is your responsibility. You should be across it. Yep, I know we're all busy, but hey, who isn't? It's a busy time of year. Life is busy, get kids, job, sports, whatever. Can't complain if you're not doing your part. Also, the other thing I see, which is there, is you're with the wrong bank. Clients thought that they were getting multiple offsets, or even thought they were getting offsets, but they didn't even have offsets. The product is wrong. You don't even have an offset account because that product doesn't even give an offset account. You've got a great rate because it's a basic home loan, but the basic home loans only have redraws. They don't have offsets because you're not paying for it. Usually you'll pay some sort of fee, annual fee, anywhere from $395, $248. There is one that doesn't charge a fee, but except they don't charge a fee, but then they charge a higher interest rate. So you're paying a fee, it's just in the form of a rate over 30 years, a higher rate over 30 years. Is it worth it? Maybe not. We probably wouldn't go to that bank. But those are some of the things that what I see that people don't use them properly. You just got the wrong advice, you got the wrong product, and you're not taking responsibility of your own banking. You're relying on other people to do it for you. So, how do we use offsets in our strategies? Well, that's a great question. That all comes back to the first thing that we do from the discovery call, which is I ask, how do you do your banking? How your current loan set up? That way I know what you like, what you don't like. I ask, do you want to do anything different? What do you like about your loan? What do you not like about your loans? What do you like about your banking? And then when we do our strategic financial diagnostic, we're looking at, all right, well, if we're trying to build out a portfolio and we're restructuring debt, so classic example, people have a lot of money and they want to see the loan balance decrease on their owner-occupied property. So they got $1 million loan. I talk about actually these clients. It's a real client. They had $1 million loan. They had about $700,000 in their redraw, and all they were going to do before they came to see me was pull the money out of their redraw and go purchase an investment property or use it as a deposit. The problem with that is, like I said before, it doesn't reduce your commitment. So it doesn't reduce your repayments. All it does is just increases your loan and you pay more interest when you don't need to. So the way we restructured that debt was use a debt recycling strategy, went to a lender with multiple offset accounts, and we actually had the loan, the owner-occupied loan, reduced. I think it was about $330,000. We ended up saving them over, I think, $4 or $5 grand a month in commitment alone. That was just their commitment that they had to make. I think their repayments ended up like maybe $2,200 a month rather than like $6 grand a month. But then what did we do with that $700,000? Well, we actually created the war chest, pull the $700,000 out as an equity loan, variable, interest only, and the money sat and offset. So they had a $700,000 loan, interest only repayments for 5 years, $700,000 credit in the offset. They weren't paying for that until they started using it. And they eventually have gone now and bought 2 investment properties, but they've taken it from the war chest. Now, why did we do that? Well, like I said, there's a few reasons. It actually separates your personal debt from your investment debt, your non-tax deductible from your tax deductible. Your accountant will love you for it. But we went one step further. On those investment properties, we created 2 new, when they got them, I told the clients to create 2 new offset accounts that were offsetting the owner-occupied loan for their rents to come into. Now you're like, oh, why would you do that? Well, 1, we can. And 2, even though the rents are going in and it's money going in, money going out, because that's where the repayments were coming from, you're still saving interest. It's simple, and you can do it if you go to a lender that allows you. So strategy plays a massive part. So that's just a little bit about how we do it. Some other people may do it differently. I tend not to have offsets against the investment properties because we don't want to offset. And if it's a tax deductible debt, let's not offset it. If we're lending under trust, that's a different story. However, you'll need to seek advice from your accountant whether you can park money in and off from your personal name in an offset account, which is underneath a company trust structure. There could be tax implications on that. So you need to speak to your accountant about that. But we want to make sure that the structure is set up and the lending set up right at the beginning to be able to keep you going. So hope you got something out of that. That is, offset accounts are one of the most misused tools, but when used right, they are a very powerful tool and it'll pay your loan off very quickly. I know because I paid my owner-occupied loan off in under 10 years using offsets, and also managed to buy another investment property, which I did that exact same strategy for with creating the multiple offset facilities to have the rental income coming in. So you can do it. I've done it. We do it for many people. Got to be diligent. I take responsibility for my own banking. Being in the banking, I've been in finance in the banking industry for over 15 years. So I know that no one's going to do it for me. You need to take control and ask questions when you need to the right people. So I hope you guys got something out of that. Like I said in all my episodes, the information on this podcast is very general in nature. If you want advice suited to your current situation, get a hold of me at Dion Finance Specialist on Instagram, financethispropertythat.com.au, Dion Fernandez on LinkedIn. This podcast is on Apple, Spotify, YouTube, if you want to see my pretty face. But until the next episode, see you then.